Hello, welcome, namaste. In today's video, I'm analyzing PolyCab India Ltd. This company is into manufacturing of cables. Let us look at the company's basic profile first. From here on, we'll move on to the detailed analysis of the company's working. From there on, I'll analyze the financial statements, that is the P&L, balance sheet, cash flow, and after that we'll do a peer group analysis, compare PolyCab with its peer group companies. Finally, we'll analyze the graph. Finally, we will analyze the company's graph and see what price levels can we buy into PolyCab. And we'll also look at the intrinsic price calculation through fundamental growth projections. So let's begin our profile analysis. The company has total 24 manufacturing facilities. All this data is up to date till 2019. The company has 24 manufacturing facilities. It has 7 manufacturing locations and 30 warehouse locations. In FY19, the company has maintained its market leadership in wires and cables. Their investments in fast moving electronic goods (FMEG) helped it to grow rapidly in both revenue and EBIT terms, with an increased share in the segment mix. All this data is in millions and are consolidated values. Let us look at the revenue mix of 2019. 86.2% came from the wires and cable business, whereas 8% came from FMEG business. And if we observe, the FMEG business has been growing steadily and is contributing around 8% to the total revenue. Other income is contributing approximately around 5.8%. So the company's reliance on the wire and cable business has been gradually decreasing from where it was in FY16 at 91.3%. Let us look at the segment income and segment EBIT, that is through which segments the company is receiving how much income. The fast moving electronic goods is contributing around 6,433 crores in 2019. The first value on the right is 2019 and the leftmost is 2016 values, whereas the EBIT generated is around 75 crores through the FMEG business. Wires and cables contribute around 69,295 million. All these values are in millions, so we can remove the last 2 digits to convert it into crores. So the company received around 692 crores from its wires and cable business, whereas the EBIT it received was around 83 crores. This is the top line profit it earned through wires and cables business. From the other business, it generated a revenue of around 46 crores. Against that, it earned 1.98 CR of EBIT. So most of the business is coming through wires and cables segment. Let us look at the production capacities based on where the plants are located. The wires and cables plant is located in Halol, Gujarat and Daman, and it has a capacity of around 3.5 million kilometers per year. In Uttarakhand, they have a fence manufacturing facility which has a capacity of around 2.4 million. Switches and switchgear is in Nasik. Lights and luminaries is in Vadodara, Gujarat with 18.2 million units. Copper rods and steel wire factory is in Gujarat, Waghodia, with a capacity of around 2,25,000 metric tons of copper and 60,000 metric tons of steel wire. Let us look at few of the ratios. The book value per share has been steadily increasing from 2015 to 2019. It started at around 115 rupees per share and has gradually climbed to around 201 rupees per share in FY19. Earnings per share has also steadily gone up from 11.35 rupees per share in FY19. This is the profit earned for every share that the company had outstanding in the market. Against that, in FY19, the earnings or profit per share has increased to around 35 rupees. Operating profit margin has been steadily going up from 9.6% in FY15 to around 12.7% in FY19. ROE values have also steadily gone up, and the company has managed to generate around 17.5% return on equity in FY19. Return on capital employed has also seen a steady uprise to around 27.9% in FY19. compared to 16.3% in FY15. Debt to equity has been steadily going down. So all the ratios are going up and the debt to equity is also steadily going down. So this is a very good value. Initially at FY19 it started with a debt to equity of 0.36 times, and in FY19 it has come down to almost 0.1 times. That is, debt is just 10% of the equity contribution in the business. Let us look at the last 9 months data up to date till FY20, that is up to date till December 2020. Company's revenue in 9 month ending FY19, that is up till December 2019 compared with December 2020. This is the comparison of 9 months of data. Overall revenue has increased from 552 crores to 670 crores in 9 month FY20. So it has seen a gain in revenue. EBITDA up till 9 month FY20 has gone up to 83 crores from its previous 9 months. The profit after tax has also increased from 36 crores to 55 crores, and as a margin it is at 8.2%. Let us summarize 9 month to 9 month comparison. Revenue has gone up by 21%. The profit after tax has gone up by 53%, and return on capital employed has gone up by 26%. Let us look at the company's customer profile. A significant portion of PolyCab's revenue comes from several orders of more than 10 million rupees. At the same time, because PolyCab is not dependent on a few large customers, concentration risk is not a source of worry. The number of customers that account for under 10 million rupees annual revenue stood at around 3,313. Let us look at the risk that this company faces. PolyCab, being predominantly a wire and cable play, is exposed to a few key risks. One of them is the fluctuation in the raw material prices, which poses a key challenge to the cable and wires industry. Realization and profitability depends on the copper and aluminum commodity prices. Typically, a change in the price of raw materials, mainly copper and aluminum and steel, may impact sales volume. Such costs are generally passed on to the customers. The second risk is the fluctuations in the rupee-dollar rate. That also poses a key challenge to the industry. Imports of raw materials like copper, aluminum, steel and insulation materials are exposed to exchange rate fluctuations, which can adversely affect the cost and thus impact the margins. Such costs are also generally passed on to the customers. The third risk is of concentration of suppliers. The suppliers of key raw materials are from a few sources and therefore places the business at risk from disruption in supply. PolyCab manages the above risk with a variety of measures, which includes contracts with suppliers, maintaining an adequate inventory, including price escalation clause for large orders, selling at prevailing market prices that reflect change in commodity prices. So this completes my basic analysis of PolyCab and what it does. Let's move on and look at the detailed profile analysis of the company. So let's begin our detailed analysis of the company's profile. PolyCab India is a leading company in the electrical wires and cables industry with a track record of over 4 decades. It is a fast-growing company in the Indian cable sector and has manufacturing facilities located at Daman and Halol. The product portfolio consists of light-duty cables (LDC), high-duty cables (HDC), and house wires, along with communication cables for telephones, coaxials, and local area network cables, and specialized cables for speakers also. It also has several consumer-facing businesses such as fans, switches, switchgears, etc. For the 9 month ended December 2019, the company reported a profit after tax of around 550 crores on operating income of approximately 6,700 crore, as against a PAT of around 360 crores on operating income of 5,522 crores for the same period of previous fiscal. This we have already checked when we first analyzed the brief profile of the company. The organized home wires and cables industry in India has a market size of around 54,000 crores, of which PolyCab is the market leader with approximately 15% market share. In 2020, the industry is estimated to have grown at 10% and is expected to continue to grow at a healthy rate over the medium term. PolyCab's market position is strong with 5,000 distribution and dealer networks and 6 warehouses. It has a significant market share in West and South India, which contributes around 70% to its revenue share. As such, its market is concentrated and thus the company is focusing on expanding its network to reach different districts of India. The company has 3 aluminium rod plants with a capacity of around 3,000 tons per month, along with its own facilities to manufacture PVC compound. In 2017, the company entered into a joint venture with Dutch firm for manufacturing copper rods with a capacity of 20,000 per month to be distributed 50-50 and now sources most of its copper requirements from this entity, benefiting the company in quality output and performance efficiency. Financial risk profile is healthy, driven by large net worth of over 3,500 crores and healthy capital structure. The capital structure is expected to improve further over the medium term on the back of steady cash accrual in the absence of any major debt-funded capex plan over the medium term. Debt protection metrics are strong as reflected in interest coverage ratio estimated at over 18 times and net cash accrual to total debt at over 0.8 times for fiscal 2020. The house wires and electrical cables segment is highly fragmented with a large number of unorganized players constraining the pricing power of organized sector players. PolyCab also faces competition from organized sector players such as Havells India, Finolex Cables and KEI Industries. The domestic electrical market is becoming more quality conscious and there would be some pressure on the unorganized players for GST compliance. Competition from organized and unorganized players in the market will continue to impact the company's operating performance. The company is susceptible to the economic environment in India. Electrical cables contribute more than 80% to the company's revenues and end users of the product include construction, real estate, power, telecommunication and automobile industries. Growth in these industries is in turn linked to the economic environment and any slowdown in GDP growth could lead to moderation in demand for electrical cables over the near term. The company is susceptible to volatility in the raw material prices, mainly copper. Copper and aluminum are the primary raw material used in the manufacturing of cables and accounts for 60 to 70% of the company's product value. Though the company revises the prices every month on basis of last month's LME prices, however, the profitability would be impacted if the company is unable to pass on the price increase to its customers. The company has healthy liquidity driven by expected cash accruals of more than 700 CR per annum in fiscal 20 and fiscal 21 and cash against term debt obligation of 80 crore per annum and capex plan of around 300 crores per annum. The company has also access to fund-based limits of 716 CR with moderate utilization. The company has sufficient accruals and cash equivalents to meet its capex and long-term debt requirements. Its unutilized bank lines are more than adequate to meet its incremental working capital needs over the next 1 year. Let us look at a few negative factors that could affect the company. Higher than expected debt-funded capex will lead to deterioration of capital structure. Drop in margins to less than 8 to 9% on a sustainable basis due to lower than expected performance in wires segment or higher cost in FMEG segment. Finally, let us end this analysis with the positive factors. If there is significant improvement in the business risk profile driven by substantial increase in the margins or diversification of product portfolio, significant scale up of its FMEG segment while keeping capital structure intact, sustained improvement in operating margin to over 14%. These are all the positive factors that may help the company in the future. So this ends my detailed analysis of the company's profile. Let's move on and look at the financial statements. Let us begin our financial statement analysis with the profit and loss account. As usual, we'll begin with the growth in sales compounded over 3 years and the latest 12 months. So we can see from March 14 to March 16, the company's revenue had increased from 3,900 to 5,200 crores. And from March 16 to March 19, it further increased to around 7,900. And in the recent 12 months, that has further gone up to 9,100 crores. So we see a steady uprise in the amount of revenue it is generating through sales over these periods. Last 3 years, it is compounding its sales at the rate of around 15.2%. And in the last 5 years, the sales are compounding at 14.82%. From March 19 to the recent 12 months, the company's sales have grown at an absolute rate of around 14.9%. The average operating profit margin of last 5 and 3 years is below 11%. Generally, we want the OPM margin to be above 15 for most of our companies. In March 19, the margin stood at around 11.6, higher than its last 3 years average. Whereas in the recent 12 months also, the margin is at around 11.6 itself, above its 3 years average. So the company's sales have increased, their operating expenses also have increased along with that. Other income's contribution to the total sales is very minuscule at around 85 crores, which is hardly 0.9%. And throughout the years, the other income has not contributed substantially to the company's profits. And when we look at the balance sheet, we can see that the company's investments in mutual funds or shares which generates revenue for the business in terms of others income would be also considerably less. Depreciation is around 1.7%, a very small figure. We'll also look at how much is the depreciation rate against the gross block or gross fixed assets that the company has in its balance sheet. Here I would like to take a moment to thank you all for subscribing and making this channel reach 1000 subscribers. Thank you all. Let us move on with the raw material cost percentage. In March 19, the raw material cost was around 78.5% of the total sales, and we can see that it was always above 70%. Company's raw material is a major expense for the company, and therefore it is very important for it to manage these expenses very well. Employee cost throughout the years stood at less than 4%. In March 19, employee cost as a percentage of total sales was 3.78%. Interest expense as a percentage of total sales stood at around 60 crores in the recent 12 months against the total sales of 9,145 crores. That's a very small percentage of 0.7. Even throughout March 16 and 19, it was always below 3% of the total sales. In the balance sheet, we'll have to check what is the debt to equity position. Although in the company profile, we have already analyzed that, but separately we will do that in the balance sheet as well. The company's tax stood at around 26% in the recent 12 months. This has substantially come down from earlier where it paid around more than 30% as tax on its profits. Value wise, it paid around 242 crores of tax on the total profit of 929 crores. Let us look at the interest coverage ratio, that is on the total EBIT, how much interest the company paid. In the recent 12 months, the interest cost was just 60 CR, and we can see the trend going down, that is the amount of interest it is paying every year has been decreasing gradually now to only 60 crores in the recent 12 months. So the company is reducing its debt. As earlier when we looked at the company profile, there too we saw in the graph how the company's overall debt to equity had been reducing over the years. So in March 16, the coverage was very bad at around 2.8 times. I want it to be more than 4 times. By March 19, it improved to around 7.5, and currently it stands at around 60 crores or 16.5 times. We can see the amount of EBIT it has been earning over the years is increasing, and the interest cost is going down. This shows the management's efficiency in controlling its debt position. Net profit margin trend is going up over the years. In the recent 12 months, the company has improved its NPM margin to 7.5% from where it started at around 3.6. It has been consistently improving its profit over the years. Along with higher sales, its profits are also increasing gradually. Although this is below my benchmark of 10%, the last 5 and 3 years average NPM was around 5.3% and 4.6. So the current 12 months NPM margin is above its averages. The net profit growth rate CAGR over 5 and 3 years has been compounding at the rate of 41 and 39%. We are seeing a very high growth in the profits that this company is earning over the years, from 89 crores in March 14 to 500 crores in March 19, whereas from March 16 to March 19 it has grown from 185 to 500 CR. Now from 500 CR in the recent 12 months it has further increased to 682 crores, which is absolute percentage of around 36.6. Moving on to the market cap to sales ratio, the company has been listed in April 2019. So we don't have the market cap to sales ratio for March 16 and March 19. Instead, we'll just look at the recent 12 months. So the company's market cap is very nearby to how much sales it is doing in the recent 12 months. That's a multiple of around 1.1. So we are getting at a good multiple to the sales. Dividend payout in March 16 was around 13%, whereas in March 19 it stood at around 8.5. So the company is not distributing a very high percentage of its profits to the shareholders. In March 19, out of the 500 CR of profit, the company paid only 42 crores as dividend. The company currently is available at 15.7 times its earnings per share. 45 rupees was earned per share in the recent 12 months, against which each share was costing around 720 rupees. That's a 15 times higher multiple than the earnings. This is a good valuation and it is below my benchmark of 25 times. So at least valuation wise, price earning, this is good. We don't have the data of March 19 and 16, so we'll skip this particular portion. But we can look at the earnings per share instead of March 16 and March 19 and compare that with the recent 12 months, and we can see an upward trend in the amount of profits it is earning per share over the years. Moving on to the balance sheet analysis, March 16 the total equity capital was 141 crores and that has remained so far till March 19. Even the face value has not got diluted and it remains at 10. Return on equity in March 19 has increased to around 17.6% compared to March 14 and 16 where it was below 10%. In March 19, the company earned a profit of around 500 crores on the total share capital or shareholders contribution or owners contribution of 2,847 crores in the business. So this is a good multiple, and now finally in March 19, it has come up above my benchmark of 15%. If we look at the last 5 years and 3 years average, that has been steadily moving up from 13% to 14.8 in the recent 3 years. So we can see an upward trend in the ROE. Going ahead in the future, we can expect an upward trend. The current return on equity of March 19 is above its 5 and 3 years average. Return on capital employed measures how much EBIT the company earned against the total funds it had with it. That is the total debt or borrowings plus the equity or shareholders contribution. In March 19, the company employed around 3,100 crores into the business through debt as well as through owners fund. On that, it earned an 874 crores of EBIT, which is 28% of ROCE. ROE trend also we saw was gradually going up, and in March 19 it was somewhere around 17%. Here too we can see an upward trend going forward from 14 to 16 and then finally in March 19 at 28%. The company's EBIT has been gradually increasing, we can see here, from 236 crores to 874, as well as the amount of capital it is employing in the business has been growing steadily upwards to 3,100 crores. Last 5 and 3 years return on capital employed has been high at around 19 and 21%, and the March 19 value is even higher than its averages of the last 5 and 3 years. Return on total assets measures what is the net profit the company is earning on the total balance sheet or on all the assets it owns. In March 19, that worked out to around 8.8%. Here too we are seeing a gradual uptrend in the increase in profits and the balance sheet size as well. In March 14, the company's total assets were 2,700 crores and that has almost doubled to 5,600 within these 5 years. So we are seeing an upward trajectory in all of these ratios, which is a good sign for the company. Debt to equity currently stands at 0.1, and here we can see the downward trend that I was talking about earlier. In March 19, the company's equity in the business was around 2,800 crores. This is the value or net worth of the company. against which the total debt stood at only 272 crores. We can see the debt has been reducing from 14 to 16 and to March 19. Over the years, the debt has been reduced, and along with reduction in debt, in the P&L account we also saw how the interest cost was coming down gradually over the years. Equity is contributing around 50% to the total balance sheet size, whereas debt is contributing just 5% in the total balance sheet. So the balance of this two, that is approximately 45%, is the other current liabilities. The contribution of equity into the business has been steady at around slightly more than 45% throughout the years, whereas the overall debt contribution in the business has been reducing from 16 and 20% earlier to now only 5% in March 19. The latest price to book ratio is 3.6 times, little higher than my benchmark of 2.5. I would want to buy when the company's market cap is around 2.5 times its net worth or below that. So currently the net worth or equity contribution in the business is at around 2,847 crores. Against that, the entire company in the market is available at around 10,163 crores. That's a 3.6 times multiple. So either I would wait to buy into this company, or I will look at the relative strength index or graph and also look at the price to operating cash flow and see how all of these valuation ratios are coming together, and then decide if I would want to buy at this valuation or not. On the right hand side, we are looking at the debt to net profit percentage. That is, out of the profits earned every year, what was the debt position along with that. Earlier in March 14 and 16, we see that the overall debt of the company was higher than the profit it was earning. In March 16, the company's total debt stood at around 796 crores. In that same year, it earned 185 crores of net profit. So it would take around 4.3 years to pay off this debt with this net profit considered. In March 19, that position is now reversed. The company can easily pay off this debt of 272 crores from the profit it earned of around 500 CR in March 19. So now the debt to net profit ratio has improved substantially. Next, let us look at how much is the net block or net fixed assets of the company. These are the tangible and intangible assets of the company, which would include your machinery, plant, equipment, and motor car, and so on, building, and so on. In March 19, the total assets, that is fixed assets, tangible as well as intangible, stood at around 22% of the total balance sheet size. The company's assets were around 1,200 crores, and we can see a gradual uptrend in the amount of assets it is holding over the years. But percentage wise, it is reducing, and that is showing a very good trend. As the total balance sheet size increases, the company's assets will increase, but we have to see a gradual increase. A very sharp increase in the amount of assets it is holding indicates that the company is growing at a very fast pace, but then that itself could be a potential trouble for it. So I generally want to see a gradual increase in how the company is growing. I don't want an haphazard growth, and if the company is deploying too much of its capital into assets or building assets, and the company in the future doesn't see the growth potential out of those assets, then it's a waste of money, and that will create a problem for the company going ahead in the future. In March 19, out of the total assets of 5,600 crores, 1,200 crores were in fixed assets, which is just 22%. I don't want this to exceed 30 or 40% of the total balance sheet size. Depreciation percentage on the total gross block. This gross block is calculated by adding the net block and the amount of depreciation deducted in 2019. So we add 141 crores of depreciation deducted from this net block, and we get gross block. That is, gross block is equal to net block plus the depreciation. So on the total gross block, that is before removing depreciation, it was 1,400 crores, and the company deducted 141 crores to the balance sheet in 2019. That works out to around 10%. Earlier, when I was analyzing the profit and loss account, we saw that on the total sales, the depreciation value was very small, approximately around 2% or so. Now when we come back to the balance sheet and look at how much the gross block is getting depreciated at, then this makes sense, because the company has to depreciate its assets at a stable rate. In March 16 also we see a 10.1% of depreciation deducted on the total gross block. So we are seeing a gradual increase in the amount of assets the company is holding every year, and on that the depreciation rate is quite stable. The capital work in progress as a percentage of total assets in March 19 stood at around 3.4. This is the amount of work that was going on in the business to develop fixed assets. So 193 crores of assets were being developed. These assets are of capital nature, meaning these are fixed assets which will get added to the gross block. So we have to see a trend over the years. Any haphazard growth is a red flag. PolyCab's cash holding in March 19 stood at around 318 crores, a substantial rise from where it was in March 16 at just 51 crores. Now what happens is, if the company has no capex, that is no capital expenditure to do, or no growth plans in the future, it can hold that cash in the balance sheet. But I would like the cash holding to be as low as possible, and most of it should be invested to generate other income for the shareholders. But if you look at the percentage, this is still considerably low at 6% of the total balance sheet size. Investments are very small at around 29 crores in March 19, which is just 0.5% of the total assets. Earlier in the P&L account, we saw that, earlier in the profit and loss account, we saw that through other income, the company was receiving a very small amount. And that is because the company's investments are also very low. Debtors percentage is very important to look at for manufacturing companies. Here we can see that the company has reduced percentage wise its debtors as a percentage of total assets. So out of 5,600 crores of total assets, 1,300 crores was still to be collected from its customers, which is around 23.6%. And the company has reduced it from where it was in March 16 at 34.5%. So I don't want the total debtors to exceed more than 30% of the total assets. Although value wise March 16 and March 19 values are almost the same, but the overall asset base has increased substantially from 16 to 19, and therefore the percentage has dropped to around 23.6. And my benchmark is, as I mentioned earlier, that the debtors should not be more than 30% of the total balance sheet size. Next, let us look at the debtors turnover. That is, are the debtors or payment to be collected from customers exceeding the 30% benchmark that I have set for myself of the total sales. That is, in March 19, the total sales was around 7,900 crores, and the pending payment to be collected from customers at the end of March 2019 was around 1,334 crores. That's 17% only. And we see that percentage wise that is dropping considerably from where it was in March 14 at 24%. Although in all these years, the company's debtors never exceeded 30% of the sales in each individual year. And that is below my benchmark of 30% here too. So I don't want the payment pending from customers to exceed 30% of the total sales for any year. Not only is the amount of debtors turnover low, but the company has also managed to collect payment from the customers at a faster rate of 61 days. Earlier, where it was in March 16 at 95 and 88 days in March 14. My cutoff for debtor days is 90. So anything above 90 days for me means that the company is not efficient in collecting payment from the customers. Here in March 19, the company has started collecting payment much faster from its customers, and currently it takes around 61 days. When we do peer group analysis, we'll look at how fast the other peer group companies are collecting from their own customers and what is their debtors turnover ratio. The current ratio in March 19 stood at around 1.6 times. The company's assets were at around 4,100 crores and liability to be paid out in the current year is at 2,500. So it has enough assets to pay off its current liabilities. Company's inventory holding in March 19 has increased substantially from where it was in 14 and 16 to 1,996 crores, which is almost 35% of the total assets or total balance sheet size. This is a substantial amount because I don't want this to exceed 30 or 40% of the total assets. This means that either the company has a substantial order book to fulfill and or it is seeing demand for its products going forward, and that is why it is holding a high inventory in its balance sheet. which is almost 35%. Earlier in March 14 and 16, it was reasonable at 21 and 25% of the total assets. On the right hand side, we'll look at the inventory turnover. This will give us a better idea. Against these sales, how much is the inventory holding? We can see that the multiple is dropping, meaning that the sales were around 4 times higher than the amount of inventory it was holding in its balance sheet. So this multiple has to be as high as possible. So we want as much higher sales as possible against the inventory holding. That does not mean the inventory holding has to go down for the ratio to go up. Even if the inventory holding is increasing, we also want the sales to increase much higher. Earlier in March 14, the multiple stood at around 6.6 times, and we are seeing a downward trend in the amount of inventory holding against these sales. This is not a red flag, but we will need to compare it with its peer group companies later on in the peer group analysis. Moving on to the cash flow statement analysis, as in all videos I mentioned that this is a very important statement to look at. In March 19, company received a profit of around 500 crores. This is what it declared in its profit and loss account as profit. Against that, it has received almost 1.4 times higher cash. The cash coming in through operating activity was 1,230 crores. So this is a good value. I want my companies that I'm investing in to receive as much cash as possible against the profit it declares. In March 16, the cash was 20% higher than the profit, whereas in March 14 it was almost 2.4 times higher than the profit declared. So these are good values. Let us look at the long-term trend of 5 and 3 years. Here too we have seen that throughout the years, the data that we have shows that the company has always received a higher cash than the amount of profit it is declaring in those years. So in the last 3 years, out of the total profit of 1090 crores, company received 1800 crores as cash. Even in 5 years, the cash coming in through operating activity was 57% higher than the profits. So these are good values. Next ratio we'll look at is the CFO to cash from investing activity. That is, out of the cash earned from operating activity, how much was put into investing activity. Investing activity would include buying and selling of fixed assets, as well as buying and selling of investment in mutual funds, shares, etc. In March 19, out of the 1230 crores of cash earned, it put 408 crores in its investing activity, which is only 33%. But in March 16, out of the 221 crores of cash earned, most of it was reinvested back into buying of either investments or fixed assets. This needs to be checked individually if someone is interested, which is almost 112%. I don't want the company to invest more than 50% of the cash earned into investing activity. Generally, in 1 year, we'll see a lot of fluctuations, but when we club it together over the 7, 5 and 3 year period, in the last 3 years in total, the company had shown total cash earned of around 1800 crores. Of that, 47% was put into investing activity. So this is good at 890 crores. Even in last 5 years, again we see that only 58% of the cash earned was put into investing activity. The same applies for the last 7 years of data, which stands at around 55%. So when we club it together and look at the trend of 7, 5 and 3 years, it seems that the company has managed its investing activity very well. Next, we'll look at the cash profit margin, which I spoke about earlier when we looked at the net profit margin in the P&L account. Here we are trying to understand against these sales, what is the operating cash flow. This is my own ratio that I've created to understand if the net profit margin is low, is the company's cash through operating activity making up for that. In March 19, company's sales were around 7,900 crores. On that, it received 1,230 crores as cash, which is 15.5% of cash margin. In March 16 and 14, it was quite low at 7.8 and 4.2. So in March 19, when we looked at the net profit margin, it was below 10%. And when we analyze it in terms of cash, that has exceeded 10%. So this is a good value. Finally, let's recap the valuation ratios. and see fundamentally at what valuations we are able to buy into this company. Price to earnings is good at 15.7, below my benchmark of 25. Price to cash is even better at 8.3, almost half of the price to earnings, which indicates that the company is earning almost twice the cash than the profit it is declaring every year. These are the current valuation ratios and they are up to date till 27th April 2020. Price to book is a bit expensive at 3.6 times. So except for price to book, all the other three valuation ratios are good. So fundamentally, we can think about buying into this company, provided relative strength index also allows us to buy into the company. Or we can use the averaging method, which I'll explain when we do the intrinsic calculation analysis. Moving on to the quarterly P&L account analysis, sales over both YOY and quarter-on-quarter has seen a double-digit growth rate of around 23.8 and 11.8%. So the company's sales have been gradually increasing over the years, annually as well as quarterly. Profits too has seen a double-digit growth of above 13% for both YOY and quarter-on-quarter. Net profit margin in December 19 stood at around 8.7%. So the company earned around 219 crores of net profit on a total sales of 2,500 crores. Here we have to look at the trend of the sales over the quarters as well as the amount of profits it's generating. So we're seeing a steady uprise in the profit as well as the sales or revenue. So this concludes my analysis of the company's financial statements. Next, let us move on and analyze the peer group companies. Let us begin our analysis of the peer group comparison. So I'm comparing PolyCab India with Finolex Cables and KEI Industries. The current market price of PolyCab is 719, Finolex is at 229 and KEI Industries is at 281 rupees. All of the companies have seen a substantial fall from their 52-week highest point. PolyCab has fallen around 39, Finolex Cables has fallen 52 and KEI 54%. The results are up to date till December 2019 for all the three companies. YOY highest growth in revenue or sales over December 18 to December 19 quarter was seen for PolyCab 23.8%, followed by KEI Industries at 20. Finolex saw a degrowth of around 6.3% from December 18 to 19. In terms of profit growth, all the three companies saw a positive growth from December 18 to 19. PolyCab saw around 13% gain, Finolex 6.2 and KEI 49.4%. Whenever we see such a high value of growth in profits or sales, we have to look at the individual values rather than percentage. Any growth rate of more than 20 or 30% should be investigated independently in terms of values. Checking out the sales of the recent 12 months with 2019 figures, all the three companies have almost done similar or more sales than 2019. PolyCab sales in 2019 was 7,956 crores. Against which in the recent 12 months it managed a very high sales of 9,145 crores, the highest seen in terms of rupees in all the three companies. Finolex Cables sales is almost flat as it was in 2019. KEI Industries has managed around 600 crores of additional sales compared to 2019. I may skip a few of these ratios as I have already covered them in the financial statement analysis. Looking at the profit after tax of 12 months and comparing it with 2019 values, we see a growth in net profit from 498 to 682 for PolyCab, for Finolex from 347 to 370, and KEI Industries recent 12 months profit at 254 crores compared to 182 in 2019. So all the three companies have managed to gain higher profits than what they earned in 2019. Comparing the PAT and the cash flows of 2019, PolyCab has received almost 3 times higher cash than what it showed as profit in 2019. So out of 490 crores of profits in 2019, it managed to generate a cash of 1,200. Finolex cash inflows were almost half of its profit declared, from 347 to 154 crores in cash. I generally would like to see higher cash inflows than the profit being declared. KEI also managed almost 3 times higher cash flows from operating activity compared to the profit it declared in 2019. We don't have the 5 years price earning values for PolyCab since it has been recently listed in April 2019. Finolex is quoting at around 21 times on an average basis, whereas KEI is at 15.2% in last 3 years. Looking at the current price earning, most expensive is PolyCab at 15.7, although this is below my benchmark of 25. When comparing it with the peer group, this is trading at a premium. Finolex is at 9.5 and KEI also at 9.9. So both of these companies are available at a good valuation. In terms of price to cash, against the operating cash flow, what was the market cap of the company? PolyCab's market cap was around 8.7 times higher than the cash earned through operating activity. Finolex cash inflows, as we saw earlier in PAT to CFO comparison, it was almost half. So here we can see that the market cap is almost 22 times higher than the amount of cash it is earning. Here too, my benchmark is that I should buy when market cap to OCF is below 25 times. KEI Industries is available at the best multiple of 4, which means that the market cap is just 4 times higher than the cash it earned in 2019. So we want to buy when market cap to OCF is as low as possible. Price to book wise, again PolyCab was the most expensive at 3.1 times. That is, its market cap was 3.1 times higher than its net worth. KEI Industries also was high at 2.8. I would want to buy when price to book is below 2.5. So the most economical in terms of price to book seems to be Finolex, but in the earlier ratio of price to OCF it was very expensive. In terms of PEG, we want it to be below 1.5 and all the 3 companies ratio of PEG is below 1.5. That is, all these 3 companies' growth rate of profits were in double digits for both 5 and 3 years. Even sales were in a positive growth rate for both 5 and 3 years. We can see these values here for all the 3 companies. Anyways, as I earlier mentioned, whenever we see a high growth rate in profits of more than 20 or 30%, we have to individually look at the values of sales and profits of the base year, that is the 5 years back value or 3 years back value, and then compare it, because that is the correct way of looking at the profits if the growth rate is higher than 20 or 30%. So in terms of PEG, all of these companies are doing good. Against the price earning multiple that we are paying for these companies, we are getting a high growth rate in that earnings also. Sales are also in double digits for all the 3 companies except for Finolex, which is in single higher digits. In terms of return on equity for 2019, PolyCab has earned 19.2%, whereas KEI generated around 26% on the shareholders' money. Finolex was the lowest at around 15% and near to the benchmark. Comparing the ROE of 2019 with 5 and 3 years average, PolyCab has managed to gain an ROE which is above its averages. Finolex Cables ROE has fallen below its 5 and 3 years average, whereas KEI's ROE is above its average. So the higher the value, the more efficient it is considered. In terms of return on capital employed, all the 3 companies have managed to generate about 20% of ROCE for both 5 and 3 years average as well as in 2019. The highest ROCE, highest return on capital employed, was for KEI, followed by PolyCab at 27%. Even Finolex has done good in generating high returns on the capital employed. In terms of return on total assets or total balance sheet size, all the 3 companies have managed a high ROA percentage for both 5 years as well as in the recent 12 months. Asset turnover is highest for KEI Industries at 3.1, followed by PolyCab at 2.6. This indicates the amount of sales the company has done against the assets or the total balance sheet size of the company. So PolyCab has managed to do 2.6 times more sales than the assets employed into the business. So this is a good value. We want it to be as high as possible. Inventory turnover for PolyCab was around 4.7 times. This indicates how much sales the company did against the inventory it was holding in its balance sheet as of 2019. So here too we want it to be as high as possible. That is, sales has to be as high as possible against the inventory holding. The highest inventory to sales ratio was for KEI at 6.8. Even if you look at how the inventory holding was 3 years back, PolyCab's inventory holding was 4.4 times, and currently it has gone above that, slightly gone above that at 4.7. And the other 2 companies are also very nearby to their 2019's inventory turnover ratio. Next, let us compare the profit after tax of 5 years with cash flow from operating activity, and finally we'll look at how much free cash flow the company has. PolyCab's last 5 years total profits, this is the net total of the last 5 years, was 1,437 crores. Of that, it has received 2,260 crores in terms of cash against the profit, which is a good value. And in terms of free cash flow, it still has around 1,000 crores left for the financing activity. It has spent around 1,200 crores in purchase of assets for the company, and that is understood. Finolex last 5 years profits was around 1,400 crores, against which its cash coming in through operating activity was only 1,000 crores, less than the profit it showed in the last 5 years. Free cash flow is almost 900 crores and has hardly spent anything in terms of purchase of assets. KEI Industries last 5 years profit is 515 crores and cash coming in is almost double of that at 1,100 crores, and 805 crores is free cash. So in terms of free cash, all of these companies have a substantial portion left over in terms of distribution in the financing activity. But Finolex Cables has less cash coming in through operating activity, and if someone is interested in Finolex Cables, they need to check out why the company is receiving less cash than the profit declared. Although it is not very far off, but we would want this cash coming in to be at least equal to or more than profit after tax. PolyCab's market cap is at around 10,000 crores, highest in the group. Finolex comes next at 3,500 and KEI at 2,500. Net worth wise, PolyCab is currently at 3,500 crores. This is the book value of the company or net worth of the company. Finolex is at 2,500 and KEI's net worth is less than 1,000 crores. I generally like to invest in companies who have a 1,000 crore and more of net worth. Anything below that becomes a little risky. PolyCab's contingent liability is 0. Finolex is at 228, which is approximately less than 10%. My benchmark or cutoff for contingent liability is that it should not exceed 20% of the net worth. KEI Industries contingent liability, if the value here is correct, then it is at 1,400 crores compared to the net worth of only 893 crores. I would be very cautious in investing with KEI Industries, or at least double check what are the liabilities that are occupying this particular portion. The highest debt to equity ratio was for KEI Industries at 0.75 and it should not exceed 1 times. Finolex is a debt-free company. PolyCab's debt is very minuscule at 0.04 times. Because KEI Industries debt to equity is high, although it is less than 1, yet it does not have a good interest coverage. Its coverage has fallen below my benchmark of 4 times. Finolex, being a debt-free company, would have the highest interest coverage. PolyCab's coverage is at 16.5 times. I have already explained what interest coverage is. Promoter holding is lowest for Finolex Cables at 35%, followed by KEI at 40%. Highest promoter holding is in PolyCab at 68.6%. None of the promoters of these 3 companies have pledged any of their shares. In terms of debtors to sales and debtor days, PolyCab's debtors or customers from whom they have to collect payment against 2019's sales were only 12.42%. So this is a good value, and all the 3 companies are doing good in keeping their debtors at a minimum level against the 2019's sales value. Although KEI Industries debtors to sales is quite high at 23%, even though this is below my benchmark of 30%. Again, in terms of debtor days, Finolex Cable is the most efficient at collecting payment from its customers within 25 days, whereas KEI Industries collection days have gone above 90, which is my benchmark, and it is taking 94 days to collect payment from its customers. I would wait for the collection days to come down even if I want to invest in this. As of now, because of a high contingent liability, I would be more cautious. PolyCab is taking around 61 days, and this is okay considering that it has brought down the debtor days from 91 in 2016 to 61 days in 2019. Net profit margin is highest for Finolex Cables at 11%. PolyCab is at 6.28, and KEI Industries profit margin has seen a lot of pressure and has fallen even below 5%. Dividend yield, none of these companies are paying a substantial dividend yield on the current market price. Finolex Cables is giving almost 2% of dividend on the current price. We will look at few more ratios. Current market price to sales is a valuation ratio against the sales. What is the market cap of the company? How much more expensive it is when compared with the sales. PolyCab's market cap is trading at around 1.16 times more than its sales. So this is reasonable. In fact, all of these companies are trading at a very reasonable market cap to sales. In fact, KEI Industries sales is more than its market cap. Enterprise value to EBITDA also is a valuation ratio. Here we are trying to understand against the EBITDA of 2019, what was the enterprise value. PolyCab is quoting at around 8.9, highest in the group. Finolex Cable is quoting at around 6.6 and KEI is at 5.6. So all of these companies are trading at a high multiple. There is no fixed benchmark for this particular ratio. 5 years operating profit margin on an average basis, if you see, both PolyCab and KEI Industries are generating around 10% of OPM margin from last 5 years on average basis, whereas Finolex Cables has maintained around 14%, although all of these three companies are below my benchmark of 15% for operating profit margin. Current ratio for PolyCab is 1.8 times, that is, their current assets were around 1.8 times higher than their liabilities that they had to pay in the current year. KEI Industries is also in a very comfortable position. Finolex Cables current ratio is quite high at 8 times, so this needs to be rechecked. Looking at the cash flow from operating activity of the last 7 years and comparing it with the free cash flow of the last 7 years, we don't have the data for PolyCab because it has just got listed in 2019. But we can look at Finolex. In last 5 years, it has generated around 1,400 crores of cash from operating activity and has 1,100 crores left as free cash. KEI Industries cash also is at around 1400 with 1000 crore left for financing activity. PolyCab has given around 9.85% return from 1 year back, whereas Finolex and KEI Industry investors have lost about 47 and 32% in their share price, which is a substantial fall. From 3 years back and 5 years back, Finolex has given a negative return of 23% and 2.5% negative return in last 5 years. So if you had invested 5 years back, your overall share price would have fallen by around 2.59%. KEI Industries has given a positive return from 3 years back and 5 years back at 8.8 and 31.8%. So this needs to be investigated as to why Finolex Cables prices from 3 years back, 1 year back as well as 5 years back has gone into negative territory. Let us look at their balance sheet total or their balance sheet size. PolyCab's balance sheet total is at around 5,700 crores. This is the total of all the assets. Finolex is at 2,800 and KEI at 3,080 crores. This particular ratio shows the size of the company in terms of asset holding. Let us look at the debt position of 2019 and compare it with what it was 3 years back. PolyCab current debt is at 132 crores and 3 years back it was 796 crores. So this has improved now. They have reduced their debt or paid off their debt, and this is a positive sign. Even Finolex Cables has reduced their debt from 51 crores, which was a very small value, and has brought down to 9 crores. In turn, KEI Industries has seen its debt go up from 498 to 665 crores. Earlier in the debt to equity ratio also we saw that it was quite high at 0.75 and interest coverage was quite low at below 4 times. Let us look at the gross block or the total assets of the company. This is the fixed assets, tangible as well as intangible. PolyCab is asset intensive at around 1,700 crores, Finolex Cable at 582 and KEI is also at 582 crores. So this particular ratio shows how much assets these companies have on their balance sheet. In terms of cash holding, PolyCab is holding around 459 crores in 2019 in its balance sheet. Finolex cash holding is very low at 50 and KEI Industries at 204 crores. This does not show anything as such, but I have kept this ratio here just to understand what is the cash holding position compared to Finolex and KEI. Capital work in progress shows that what is the amount of work currently going on in the company in terms of building new assets for the company. PolyCab is working on assets of 264 crores. Compared to Finolex and KEI, which don't have a very high capex or work going on in the business. Operating cash flow to the net profit compares how much cash the company received in 2019 against the profit declared. PolyCab has received around 1.4 times higher cash than the net profit of 2019. Compare that with Finolex, whose cash inflows were falling short by 62% of its profits. KEI Industries is also receiving higher cash of 2.4 times more than the profits. So both KEI and PolyCab have done good in terms of generating high cash for the companies. Let us look at the growth rate in the operating cash flow from 5 years back. Some of these ratios are new and I've just added them here to understand it in greater depth about the companies. PolyCab's operating cash has been growing compounded at a rate of around 31%. So just like we have the profit growth rate, we can also calculate operating cash flow growth rate. Finolex Cable has seen a 7.2% degrowth in its cash generation through operations from 5 years back, whereas KEI Industries has seen a 49.5% growth in its operating cash flow. PolyCab's price will have to move around 66% up to come to its 52-week highest point, and Finolex Cables has to go up almost 100% to reach its 52-week highest point, and KEI Industries will have to move up around 120%. And from its low, PolyCab has moved back to around 34%. So whatever lowest point it had reached in last 52 weeks, from there it has come back 34% and still has to go up 66% more to reach its 52-week highest point. Finolex Cable has moved up 47% and KEI Industries has seen a recovery of 34% in its stock price. Finally, let's complete this by looking at the institutional holding. The higher, the better it is, as that gives strength to the company's profile. Foreign institutional holding in PolyCab is low at 4.6%. Finolex has FIIs holding around 7.3%. Highest holding of FIIs is in KEI at 14.5%. Even DIIs are holding a very substantial portion in KEI at 24%. Finolex DII holding is at around 20 and PolyCab at around 13.4. Mutual funds are holding around 3.2% in PolyCab, whereas Finolex and KEI Industries is slightly above 19%. So if we have to summarize this, then KEI Industries has a substantial holding of FIIs, DIIs as well as mutual funds, and therefore it gives a lot of strength to KEI Industries. But we'll have to figure out a few of these ratios in KEI as to why the contingent liability position is so high compared to its net worth, and why is it trading at discount to its net worth. So this completes my peer group analysis. Next, let us look at the technical chart. So continuing with our technical analysis, because the company was listed on 18th April 2019, we don't have a substantial data to draw multiple support and resistance lines. Also, looking at the RSI at the bottom of the screen, we see that it is still above the 35, which is my benchmark. So as of technical, I don't think I'll be able to make any conclusion, but if we just purely look at the fundamental valuations like price earning, price cash, price book was expensive, and price to sales and so on, we see that it was reasonably valued at current price. And if someone wants to buy, they can use the averaging method, where every 5% up or down they can buy a fixed portion of their total investments and try to average and try to keep their average price very near to the current market price. Going down, I have two levels of 650 and 584 rupees. Here, if someone wants to buy, this was a good support and resistance lines. If the prices keep moving up, you can even average every 5% going up. I would generally break up my investments into multiple parts of at least 10 or 15 times. I understand this is a lot of work. If you want to keep our average price very near to the current market price, we will have to put a little bit effort into investing systematically. And in almost all the trading softwares, you will find an option called valid till cancelled, in which you can put an order to buy at a certain price point going ahead till say 3 months in the future. So till 3 months you don't have to do anything, you just put in the orders and that will get executed as and when that price comes, either 5% up or 5% down, or whatever percentage you want to keep depending on your comfort zone. So as far as technical is concerned, I don't see much support lines except for 650 and 584, and using the averaging method we can buy up and down. I generally don't suggest averaging method until and unless the company's fundamentals are very good. So after analyzing and looking at all the data, I would conclude that I would buy into this company if the price comes down, and even if it goes up a little bit, I would do the averaging and try to accumulate the scrip of this company in a systematic manner. Since we have the price data only starting from April 2019, we won't be able to project the intrinsic price calculation for this company, and therefore I conclude my analysis for this company here. If you have any doubt, queries or questions, or would like to get in touch with me, do let me know in the comment section and I would be glad to help. Thank you for watching this video. Dhanyavad. Namaste.